Welcome to Yadnya Investment Academy. Today we are going to learn what are balanced funds. Balanced funds are also known as equity oriented hybrid funds. These funds are a combination of equity as well as debt. But since they are known as equity oriented funds, the equity portion is predominant and is around 65 to 80%, and the debt portion is around 20 to 35% of the entire invested corpus. These funds provide capital appreciation through equity and safety through debt. Equity portion over here gives the fund opportunity for high growth, whereas debt gives the required cushion in case equity fails to perform. Returns from these funds have been around 12 to 14% on an annual basis in the past 10 years, whereas from taxation point of view, equity oriented hybrid funds are treated same as equity or equity funds. And hence, if you hold on to your funds for more than a year, your returns are not taxed, and in case you redeem your investments within a year, your returns are taxed at 15%. Let's look at the advantages of these funds. The first is rebalancing. Let's understand what is rebalancing. Let's assume there are 100 rupees in our equity oriented hybrid fund, where 70% or 70 rupees are invested into equities and 30 rupees or 30% are invested into debt. This is our initial constitution. Due to certain decisions of the fund manager, these 70 rupees grow to 100 rupees and the debt portion remains at 30 rupees. So now the equity portion has grown to 77% and the debt portion has come down to 23%. Now a fund manager has to rebalance this portfolio to bring it again to 70% equity and 30% debt. So he sells off a certain portion of equity to bring down the percentage to 70 again and reinvests the profits booked into debt to increase the allocation back to 30%. This is called rebalancing. So if you invest into these kind of funds, your portfolio is rebalanced automatically without you having to worry about it. The next advantage is switching. In case the equity market is moving upwards, the fund manager can allocate more funds into equities. And in case the equity market is moving downwards, he can allocate more funds into debt. So rebalancing and switching bring down the overall cost of portfolio management, making these funds very cost effective. These funds are truly diversified, where you invest into two asset classes, one is equity, another is debt. So we have seen what are balanced funds today. We have seen their returns, we've seen the taxation, we have also seen the advantages of these funds. Hope you know what are balanced funds now. Thanks for watching the video. Watch this space for more such topics. Until then, happy investing.